How do you determine the cost of a mutual fund? Is a mutual fund expense of, say, 1% a good deal? And aren't expensive mutual funds much better than those cheap funds? We'll answer these questions and more on this, the 28th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to day 21 of the 31-day money challenge. Today we're going to look at a very critical investing topic, and that is the subject of costs, fees. It's a super important issue really for a couple of reasons. One is fees over a long period of time, over investing 10, 20, 30, 40 years, have a huge impact on your return. I think a much greater impact than most people realize, and we're going to take a look at that today. And the other thing is unlike most of the bills we're used to paying, you don't actually get an invoice in the mail. You don't have to write a check each month or each quarter and send it into the mutual fund company to pay for the expenses. Instead, they just take it out of your investing returns. And so if you have a return over the course of a year of, say, 10%, that's net of fees. They've taken fees out. And to figure out exactly how much they've taken out and how much, what impact that has over the long term, you really have to roll up your sleeves and dig in. It's not a very easy thing to figure out, and it's really easy to just completely ignore and forget about. I talk to countless people who have no idea how much their investments are costing them. And so today I'm going to show you how to figure that out, what the numbers mean, what the impact is over a lifetime of investing, and the importance of finding super cheap mutual funds. So that's what we're going to do today. I've also got a couple of reader questions that I want to share with you as well. So let's get right to it. First, I want to just thank our sponsors for this 31-day money challenge. The first is Betterment. They are an online platform that invests your money for you in both stocks and bonds. You just select what percent you want in each, and Betterment does the rest. They rebalance your portfolio for you to keep it in line with your goals, as well as reinvesting your dividends automatically. You can check them out at betterment.com. And our second sponsor is Personal Capital. It's a free online tool that allows you to connect all of your investing accounts in one place, check the performance of your investments every day. You can easily see how your asset allocation across multiple accounts, as well as the fees that you're paying. You can check them out at personalcapital.com. Okay, so we have two reader questions today, and although they're on different, related but different topics, they both kind of raise a similar issue. So let me start with the first question, and this comes from a reader named Rob. He says, I've started listening to your podcast this year and I'm enjoying the 31-day challenge. I just opened a Betterment account. What are your thoughts on using Betterment to hold my emergency fund and vehicle savings? I currently have them fully funded at Capital One 360 in cash. Betterment advises to use their company for these types of accounts, but I think they are obviously biased toward their own offerings, and then he includes a link to an article on Betterment that they wrote arguing that your emergency fund would be best served in a mix of stocks and bonds. And then he concludes, I would appreciate your thoughts on this. So I've already gotten back to Rob in an email, but I think this is really an excellent question for a number of reasons. First is, he's read something on a site and he thinks it might be of use to him, but he's questioning it. And he should. We should question everything we read. You should question everything you hear on this podcast. Sometimes it's not that something that's being suggested is necessarily wrong. Sometimes it is. Sometimes it just may not be right for you. And I think, particularly with an emergency fund, whether you're talking about how much you should have in an emergency fund or where you should hold it, should it be in a savings account, should it be in a CD, should it be in a bond fund, should it be in stocks and bonds, as Betterment's suggesting, that can vary from it can not only vary from one person to another, but it can vary over your lifetime. I mean, how I treat my emergency fund today is very different than how I treated it, 10 years ago. So it changes as your finances change. And so I think Rob is right to explore this, see if it makes sense for him, and if it does, great. If it doesn't, then obviously stick to what he's doing. I think most people, when they hear this, though, their sort of knee-jerk reaction is all of your emergency fund should be in a FDIC-insured savings account. And there's a couple things about that. On the plus side, of course, there's no risk, assuming the emergency fund doesn't exceed the insurance limits of the FDIC, and I'm going to take a stab and say it probably doesn't. It's very secure. You're not going to lose any money. That's the upside. The other upside is it's liquid. You can get at it very quickly. And those are obviously two very important considerations with an emergency fund. The downside is that you're not earning much interest, and in fact, the interest that you're earning is less than the rate of inflation. So the purchasing power of the money you have in a savings account is eroding over time. I think inflation last year was 1.5%. I may have that wrong, but I think that's somewhere in that area. And a typical online savings account like Capital One 360, and I have a Capital One 360 account, is paying about 75 or 85 basis points, I think. So it's less than inflation, and and that's not unusual. So that's sort of the cost of keeping your money in a savings account. Now, my view is, and it's changed over time, but what's right for you is going to depend on a lot of factors. I mean, for starters, if you're still paying off non-mortgage debt, my view is you want to keep as little as you possibly can in an emergency fund, putting aside where you keep it for a moment, so that you can tackle your debt. I mean, when we were getting out of debt, we had virtually no emergency fund. We relied on an available home equity line of credit should we ever have an emergency. And fortunately, we didn't, or at least nothing of any significance. But for us, it wouldn't have been, should we keep it in cash at a bank or at Betterment? We really didn't have an emergency fund to speak of, and we were comfortable doing that. Today it's very different for us. Our non-mortgage debt is paid off, and frankly, I don't really think of my money in terms of an emergency fund. I kind of think of it more in a holistic way. I don't segregate my money and say, okay, this amount is specifically designated for an emergency. What I do is I keep 3 months of expenses in cash in a savings account, and then the rest I keep is just part of my asset allocation of my overall investments, which is an 80-20 split, 80% stocks, 20% bonds. That's actually more aggressive, I guess, than what Betterment was suggesting. And I do recommend you read that article. I will leave a link to it in the show notes, because it's a little more detailed than just keeps your emergency fund in stocks and bonds. It talks about an allocation that would be appropriate for that, and it actually has an approach where you would keep more than what you might think you need for an emergency fund in that mix. So if this is something that's of interest to you, I would suggest you check out the article. For me, you absolutely want something in cash. That's my opinion. Now, what that will be may vary. For me, I'm comfortable with 3 months. Part of that, though, is a function of the other areas of our finance. This is where I don't look at things in isolation. It's a function of the fact that we don't have any non-mortgage debt. It's a function of the fact that we have plenty of available credit, and it's a function of the fact that in our investment accounts, yes, they could go down at a time. You can imagine the worst case scenario. The stock market plunges, the bond market plunges, I lose my job and all my other sources of income, and we burn through our 3 months of cash. And then what? Well, then we're left using our investments that have gone down in value. And so I'm willing to take the risk that all of those bad things are going to happen at the same time. I guess it's possible, not likely, but it's possible. But for me, I'm just comfortable with that, given the amount that we have in our investment accounts and all of the other factors that sort of go into your sort of total picture of your personal finances. I wasn't comfortable doing that 10 years ago. It didn't. My finances didn't look like that. So that's, I don't think there's a yes, no here or right or wrong. I think you need some money in cash. That's my view. I want to be able to get at it quickly, and I don't want to be in a position where I'm selling stocks that are down. But I am looking seriously, for example, do I really need 3 months cash? Maybe I only need 2 months of expenses in cash and can take that extra month and add it to my portfolio. So, I am constantly looking at that issue and making slight changes. So that was my view. Now, I will say he mentioned also a vehicle saving. So I gather he's saved for a car, and he's going to be buying a car at some point in the near future. To me, that's actually a little different because, with an emergency fund, you don't know when you're going to need it, if ever, right? I mean, it could sit in the bank or in Betterment or wherever you keep yours for quite a long time. But I presume he knows when he's going to be buying a car, or at least has some rough idea. And so that's money he knows he's going to spend. He may not know exactly when, but I'm guessing he has a pretty good idea. And let's say that's a year from now or whatever, or 2 years from now, I would not be investing that money because you don't want to be in a position where you lose 20 or 30% and then you don't have enough to buy the car. That's my view. That's how I would look at it. But again, if you have a view on that, feel free to shoot me an email, dr@DoughRoller.net. So that's the first question. The second question comes from Kenneth. He writes, regarding your questioning an 80% stock allocation for a young person, you're probably dead wrong here. It should be 100%, and he suggests VTSAX, which is the ticker for the Vanguard Total Stock Market Fund, he says would be the best single choice here. But even SPY, S&P 500 index would be good. It's an S&P 500 index fund. He goes on, the thing is, they are dollar cost averaging by saving some of their earnings every paycheck. They can expect several market meltdowns during their accumulation years. These are great for young people. Stocks are on sale for several years during these periods. Eventually, the market recovers. They always have. Well, first, Kenneth, thank you for your perspective. And in some ways, I don't disagree with you. If we had Rick Ferry on the show. I think it was podcast 2. No, I think that's wrong. I'll look that up while I'll look that up and get that right here in a second. But I think his kids were all 100% stocks, and they were in their 20s, and he was comfortable with that. But here's the issue: are you going to stick with that allocation when the market is down 50%? I mean, if you are 100% stocks, let's say you've invested in the VTSAX, the Vanguard Total Stock Market Fund. You ought to be prepared to have your portfolio lose 50% of its value over some relatively short period of time, whether it's 12, 18 months, whatever. That it will likely happen over your investing horizon, assuming it's many years. And so, the question is, are you going to be able to stick to your plan when that happens? And in some ways, it's hard to know that until you actually go through it. We can all sit back and kind of, I think I'll stick to it. Maybe you will. I think you'll find out though once you actually live through it. So that's the first thing that I would say. If you that kind of allocation, I wouldn't agree with if you have doubts about your abilities to stick with it. The other thing I would say is, I'm not actually sure that 100% VTSAX would necessarily outperform, say, an 80-20 split. I mean, there are studies that show that actually a little bit of bond exposure can increase, believe it or not, increase your returns, or maybe not increase your returns, but keep them pretty consistent to 100% stock allocation and reduce your risk, meaning reduce your volatility from year to year. That's my view there. Again, if you're young, 100% stocks, I don't think is a bad idea, but only if you're going to stick with it, and that's the big question. And I've got it here. The Rick Ferry interview was podcast 3, so you can check that out. DoughRoller.net /podcast 3. If you don't know Rick, he's written some excellent books on investing, including All About Asset Allocation, which I think is a phenomenal book to read. And he and his company manage, I think it's about $1.3 billion in assets. And he's a big believer in the Vanguard low-cost index, passive investing. Set your allocation and stick with it. And anyway, Kenneth, appreciate your views on that. And as always, if you have questions, love to get them. dr@DoughRoller.net. Okay, so now we're going to go to fees, and this is a perfect segue to this. So I want to answer, I guess, 4 questions today about investing costs. The first is, how much difference does this really make? We're going to look at an example. The second question is going to be, well, isn't performance of a fund the ultimate concern? I mean, so what if a fund has high expenses? If its returns are a lot more, then isn't that really what matters? And so isn't it your net performance after fees what we should be concerned with, not the fees themselves. And then we're going to look at very practical how you determine the fund's expense ratio and how exactly does that work. And then the fourth one is, all right, with all this information, that's great, but what should our goal be? What are we trying to do here? What's a reasonable amount of fees to pay? And for that, I'm actually going to look at a very, what I think is a very sound example of an asset allocation with 3 specific funds, and we'll take a look at what those would cost you. Okay, so let's start. Question 1, how much difference does it really make? And this is pretty simple to do. I mean, I've come up with just 3 examples. Imagine you invest $1,000 a month for 40 years and you earn 8%. And I know we can debate whether 8% is the right number. For our purposes, it doesn't matter. And you'll see why in a minute. So what would you end up with? Now, we're not adjusting for inflation, right? I mean, over 40 years, you'd probably end up saving more per month eventually. And of course, what you'd end up with wouldn't be its value would have to be adjusted for inflation in terms of today's dollars. But for our purposes, that doesn't matter. It's $1,000 a month invested for 40 years at 8%. What would you have? Well, I went to a trusty online savings calculator, and the answer is $3.5 million. Now, let's adjust that a bit. Let's assume you invested in some expensive mutual funds, and they took an extra percent out of your returns. And so rather than making 8% a year on average, you made 7%. So again, it's $1,000 a month for 40 years, but this time you only earned 7%. Does that make a big difference? Well, only $900,000. So I guess I'll leave it to you as to whether that's a lot. But your $3.5 million, because of that extra 1%, actually drops to $2.6 million. And then for our third example, because you may be saying, well, that's 1%, that's a lot, but maybe 0.5%, that shouldn't make a big difference, right? Well, again, the same example, $1,000 a month for 40 years, and let's say you make 7.5%. You only lose 50 basis points because you're investing in expensive mutual funds. The result is $3 million. So that 0.5% over 40 years would cost you $500,000. Now, you can use whatever different numbers you want. Some people save a lot more than $1,000 a month. Some people save a lot less. Some people don't save for 40 years. But the end result is the same. Small differences in fees, small differences in performance, multiplied month after month, year after year, make a huge impact to your portfolio and what you end up with when it comes time to retire. And it's so easy to kind of lose track of this. Day to day, your fees don't make a big difference. Even in 1 year, they might not make a huge difference. But when you start to compound these differences over decades, they make a huge difference. And that leads us to question 2, and that is, okay, but we're talking about performance here. And so, if I invest in an expensive mutual fund, maybe it costs me 2%, 1%. But I mean, if its returns, are better than your index fund that might be inexpensive, who cares? I'm getting my money's worth. I'm paying extra, but I'm getting much, much better returns. And the problem there is, of course, that over the long term, those expensive funds don't get better performances. In fact, over the long term, and we discussed this, I guess it was 2 podcasts ago, that over the long term, actively managed funds, those expensive ones, underperform the indexes. And one of the big reasons that they do is because of their expenses. When a fund is charging 1%, it's not good enough that they just beat the index by a little bit. I mean, they've got to beat the index year in and year out for decades by 1 full percent just to break even, if that's their expense ratio. Some charge more than that. Some charge 2%. So that is a huge hurdle to clear. And they may clear it in any given year or even in a couple of years. Very, very few, but occasionally you'll find some that maybe clear that for a decade. But over a lifetime of investing, they don't. And more importantly, as we sit here today and have to make investing choices, we have no way to know which of the very, 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 very few actively managed funds that might beat the index over a long period of time, which ones they are. We won't know until we look back after 20 or 30 or 40 years of investing, and by then it's too late. So yes, ultimately performance is the issue, but there's no way we're going to be able to pick those really expensive funds and know which ones, if any, are going to outperform the sort of passively managed index funds over a long period of time. And contrast that with the expense ratios. That's one of the few things we can control, right? We can't control the market, but we can control which mutual funds we buy and what we're willing to pay for them. And so by selecting low-cost mutual funds, that is taking advantage of one of the few things that we can control in this whole crazy world of investing. And so it's something, given the differences over a long period of time a small fee can make, this is something that we absolutely have to be focused on. And that brings us to question 3. How do we focus on it? How do expense ratios work? You've probably heard that term. What does that mean? How does it work? And how do you find out the expense ratio of a mutual fund? And so most of the expenses of a mutual fund are expressed in what's called an expense ratio. So you can imagine an expense ratio of 1%. And what that simply means is the cost to invest in that mutual fund for a year would be 1% of the amount you have invested in that fund. It's as simple as that. Now, a lot of funds are, in fact, the ones that we'll focus on today are a lot less than 1%. You'll find mutual funds, index funds. We're going to look at one today. Its cost is 0.05%. That's just 5 basis points. It's very, very inexpensive. And so you would multiply that against the amount you have invested, and that's the amount in expenses that you would be charged for that mutual fund. Now, there are some other expenses that are not captured in an expense ratio, particularly as it relates to trading costs that a fund incurs. And the reason for that is that looking forward in 2014, mutual funds don't know what their trading costs will be because they don't know yet for certain what they're going to buy and sell, what volume they're going to buy and sell in, how frequently they're going to trade. And so those actually are additional costs that don't typically get factored into an expense ratio. Now, for an index fund, for the most part, that's not a big deal because they're not doing a lot of buying and selling. There's not a lot of turnover in that kind of fund. Now, for an actively managed fund, though, you could end up spending a lot. The trading costs can really add up. But we're not going to really focus on that today because we're going to stick with index funds. And for the most part, that's just not a significant concern. But we still want to know, so what is the expense ratio of a fund? And you can find this in the prospectus. You can find this on mutual fund websites. I like Morningstar. We looked at Morningstar when we talked about picking individual funds. If you go to Morningstar.com, and I'll just use as an example the Vanguard Total International Stock Index Admiral shares. The ticker is VTIAX. And this requires $10,000 minimum to invest, but you get relatively low expense ratio. The expense ratio here, when you punch in that ticker into the quote box in Morningstar, it brings up the information on that fund, and you can see it right towards the top under expenses. 0.14%. That's 14 basis points. That's just a fraction of 1%. Very, very inexpensive. And in fact, there's an expense tab that Morningstar has. If you click on that, it'll give you even more details. It'll show you, for example, your cost per $10,000 if you invested in this fund for 3, 5, or 10 years. So, for example, over a 10-year period, if you invested for each $10,000 you invest, this fund will cost $205. Again, that's not per year, that's per decade. So again, a very inexpensive fund. The other thing that Vanguard will do is compare the cost of this fund to the category average. This is an international stock index fund. So as compared to the category average, this fund is 14 basis points. The category average is 124 basis points, 1.24%. There you go. That's over a 1% difference. So a very important thing to figure out to make sure you're getting low-cost funds. And with Morningstar, it literally takes you 20 seconds to figure out the cost of a mutual fund. Very easy to do. There's no excuse not to do it. And so with that, I get to the fourth and final question for today, and that is, well, what are we aiming for? I mean, if what would be a reasonable expense ratio for a fund? Some funds in our portfolio may be a little more than others, so we got to kind of figure out a weighted average for all of our investments. What would you consider to be reasonable? So when I started to focus on fees a number of years ago, my goal was, when I added up all of my fees across all of my investments, sort of did a weighted average, based on how much I had in each fund, I wanted my total cost to be under 50 basis points. And I remember when I think it was 48 basis points, I'd calculated it. I think that may even show up in one of my older articles on DoughRoller. But that was my goal. And then after a while, I thought, this is ridiculous. I need to get it lower than that. So I wanted to get it below 25 basis points. That was really my goal. And ultimately, though, the goal is to get it as low as possible. And I wanted to just give you a real quick example. We talked about sort of a core portfolio that would include a U.S. stock index fund, a bond index fund, and a international stock index fund. Just 3 mutual funds gives you a well-diversified portfolio. I think that could be, for me, certainly is sort of my core portfolio. I had other things like REITs and commodities, and I have some additional emerging markets. But I think particularly if you're starting out, for most people, those 3 asset classes really should represent the core of what you invest in. And so what would the expenses look like for that kind of portfolio? Well, if you went with Vanguard low-cost index funds, and I'm looking at 3 right now. So for the U.S. stock asset class, the Vanguard Total Stock Market Index Admiral shares, ticker is VTSAX, and you need $10,000 to invest in this fund. It's a tad bit more if you have less than that, but eventually you'll get there. Cost, 5 basis points, 0.05%. That's your U.S. stock allocation, your total bond market. Vanguard Total Bond Market Index Admiral Shares, VBTLX is the ticker, 10 basis points, 0.10%. And then the last one for international stocks, the Vanguard Total International Stock Index Admiral Fund, VTIAX, and that's a whopping 14 basis points, 0.14%. And there you go. You've got a great, I think, a great diversified portfolio. By the way, I own shares in each of these. I should disclose that. I do own shares in each of these. I think they are great investments. And of course, your actual, in terms of your weighted average, it would depend how much you had in each one. But, one's 5 basis points, one's 10 basis points, and another's 14 basis points. So if you had roughly the same amount in each, you'd be looking at a total of 10 basis points as sort of a weighted average, roughly, which would translate to, if you had $1 million spread out in these 3 funds, your annual cost would be $1,000. That is really, really inexpensive, and so easy to do. A very simple portfolio, 3 mutual funds. You're well diversified. You're covering the entire stock market. You've got a wide coverage of the bond market, and of course of international stocks as well. That international stock index fund, by the way, gives you exposure not only to developed countries, but it also gives you exposure to emerging markets, which I think is so important. I don't have that fund in front of me, but I think it's around, well, actually I do. I think it's around 14% emerging markets. Let's just check that out. We can go right to, I've got it up in Morningstar. I can click Portfolio, the Portfolio tab, and scroll down to the bottom. Let's see here. Yep, 14.1% emerging markets, 85.9% developed markets. So there you go. 3 funds, and you're well diversified for next to nothing. And it's really as simple as that. I hope you really take this podcast to heart. This is maybe not the most exciting topic, mutual fund expense ratios. You talk about this, you're not going to be the life of the party, but I'm telling you, it will have a huge impact on the performance of your portfolio. If you don't know what your mutual funds are costing you, you need to find out now. And that's particularly true in 401ks, where it can be hard sometimes to find investments that are low cost. Hopefully, and I think most 401ks actually are getting better at this because it's becoming more of an issue. It's being publicized more. But you really want to know what your mutual funds are costing you. Morningstar will tell you that very quickly. If you have the ticker symbols for each fund, you can figure it out and hopefully keep those expense ratios. Again, my sort of rule of thumb is to keep it below 25 basis points. As I said, I have REITs. I have a separate emerging market fund. I have a small cap fund. I have a commodities fund. Those tend to get a little more expensive. But you add to that individual stocks, and I'm not recommending that for everybody, but I have some, and that there's, of course, no expense ratio for that. I'm able to keep everything around 25 basis points, maybe even a little lower. And I think if you can do the same thing, you'll be in good shape. And if you want to share with me any tricks or tips that you've come across to keep your investing costs low, would love to hear them. And if you check out your expense ratios, shoot me an email. Let me know what they are. I'd love to kind of just get a sense as to how everyone else is doing and where everyone else stands in all of that. So with that brings our show to a close. You'll find the show notes at DoughRoller.net/podcast 28. As always, you can leave me a voicemail with a question or comment. Just go to speakpipe.com/DoughRoller. Love to get email, dr@DoughRoller.net. I read every email and I respond to every single email. You can subscribe to this podcast. Just go to DoughRoller.net/iTunes. That will redirect you to the iTunes page where this podcast resides. You can subscribe there, and love for you to leave a review. I've seen more and more reviews. I really appreciate those folks that have taken the time to review the podcast. Helps me know what I'm doing right, what I'm doing wrong, hopefully improve the show for everybody. And lastly, if you haven't already, sign up for our newsletter, DoughRoller.net/newsletter. Goes out every Saturday, packed full of resources and tips to help you make the most of your finances. So until next time, remember, the best thing money can buy is financial freedom.